Okay, good morning, everyone, and welcome to the slightly delayed start of day 2 of the Coffee Microcaps Technology Conference. You're all very welcome this morning. My name is Mark Tobin, the founder of Coffee Microcaps, for anybody who is joining us for the first time. And if you're one of our regular attendees, welcome to this morning's event. I'm just going to quickly run through some slides, and then we're going to get straight into it with our first presenter this morning. First off, I'd like to give a shout out to DMX Asset Management. If you're looking for a smaller microcap fund manager, please do check out their website, or indeed get in touch with Stephen or Michael for the relevant PDS on their two funds. They are our virtual event sponsors here at Coffee Microcaps. I'd also, for this event, like to mention RAS Group, who are providing one-page kind of overview notes on all of the companies presenting. You can find them easily on the RAS LinkedIn page, probably the best place to go. And they are our research partner and sponsor for today's event, and indeed yesterday's event. Quick compliance and disclaimer slide. The companies presenting this morning basically follow the same criteria that for anybody who joins our kind of weekly events, the morning meetings. All the companies here capped under 300 million are in revenue and approaching cash flow break even, or indeed in some cases are already profitable. We generally don't have companies from outside the biotech or resources sectors, what I like to call industrial microcaps. Structure this morning's webinar, we were due to have 6. Unfortunately, Gnosis had to cancel late in the day on us, but we've got 5 companies presenting over the next 2.5 hours. Each company is going to get 30 minutes, which we'll break down into a 20-minute prezzo and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate the questions. You can follow us on all the social channels, Twitter, YouTube, for the recording of this webinar, and indeed you'll catch the recording of yesterday's event if you couldn't join us on there, as well as a host of other morning meeting events. We've got well over 100 ASX microcap company presentations up there now. LinkedIn, and I also write a free monthly newsletter which you can get on the Substack platform. So this morning, we're going to have Gerard Dyson from Spectur is going to be our first presenter. After Gerard, we're going to hand over to welcome back, actually, Kate Quirke from Alcidion Group, who has presented in the past and is coming back to give us an update on all things ALC. Then delighted to welcome another new presenter after Kate. We'll have Paul Gillespie from Smart Parking. Then we'll have another new presenter, actually, Rene Sugo from Symbio Holdings. And then rounding out this morning's presenters, we'll be welcoming back Rob Broomfield from AVA Risk Group, who has presented on a couple of occasions in the past. So that's enough from me. I'm going to stop sharing my screen and hand over to Gerard, who's actually patiently waiting for us in Los Angeles. He's on the road, but he's taken time out to give us an overview of Spectur. Gerard, I can see the cover slide of your presentation, so take it away.
Well, thank you, Mark. It's an absolute pleasure to be talking to you guys today. I really appreciate the opportunity, and I think I've got a pretty exciting story to share. Here's an exciting slide you can read at your leisure. So first, for those people that are a little bit new to Spectur, we are quite a different company. So I'll just explain a little bit about who we are and what we do before I lead into some of the other juicy, exciting bits. So Spectur is a company about making communities safer. It's our purpose, and we focus on doing that in places where you can't have power or you don't have access to a wide internet. So we provide platforms and solutions that can sense problems, make a decision, and take an action, and they do that without a cabled connection. So, what does that look like? What sort of things are we talking about here? We are able to improve safety and security in off-the-grid settings. So, for example, we're able to reduce problems with trespassing, theft, illegal dumping, hooliganism, graffiti and the like. So sort of security surveillance type problems. But we're also able to increasingly support challenges around floods, bushfires, shark attacks, and the like, where we provide both a warning system, a communication system, and other ways of providing data in those environments as well. So I guess the challenging thing about these sort of problems that I'm showing in the middle of the screen there are that not only are these things increasing both in frequency and consequence, but we are almost getting a constant diet of it through our media. And that means that people's sensitivity and awareness to these sorts of risks are growing as well. And there's an increasing level of demand to either mitigate or reduce the risks associated with these sorts of challenges. And we believe that we have a platform that's very, very good at doing that, where the current solution is usually do nothing and hope for the best. So what does this look like? This is I would say typical, but there's many different varieties of platforms we have. This is kind of what our ecosystem looks like. If you have a look on the left, we have a solar powered platform. It's got solar panels at the top. It's got a box or a device which has cameras, processors, light, speakers, and the like. This one has a digital signboard on it. Further down, there's a two-way VoIP phone, so someone could have a conversation as well. So these platforms can be located in a variety of places. They can be in the middle of the city in a construction site, or they could be on a campsite, miles from nowhere, or they could be on a beach, for example. So they can be in a lot of locations where either for convenience, you can't put power in, or it's expensive, or you only need them temporarily, or there's simply no ability to run a cable to it. Now, these systems themselves, they can sense, think, and act. And I guess the best way to describe how this system works is with a short example. I'll use a construction site because it's a fairly common application. These systems, for example, can be used to capture time-lapse video. They're very useful for live viewing. So if you're a construction manager with 3 or 4 sites, you can click on the phone app, for example, and you can see live what's happening on your site. You can talk to people and they can talk back to you through the speakers and the microphones. You could be, recording every bit of movement that occurs on the site. So you can go back and do claims management. Say, for example, there was a safety incident, you can go back, capture that footage and see what actually happened. But one of the main applications that it get used for is security. And so, for example, if you're on a construction site with valuable materials at night, you can't afford to have a security guard, a fence is not enough. This system will watch the entire time. So it's sensing. Now, it senses not just with the cameras, but it uses other types of sensors depending on how it's configured as well. And it's looking for, for certain events. So at a certain time when it's scheduled to be on, it might, for example, there'll be 2 young fellas in hoodies jumping a fence. Now, the camera has detected that they're there and it's seen them. And then it uses the on-the-edge artificial intelligence or the cloud intelligence, depending on which one model we've got, to determine, is that movement that I'm seeing a person or a vehicle, or is it something else? Because if it's something else, that I'm not caring. I don't mind if a branch is moving or if a dog's run past or if it's a wind or whatever it is. I'm only interested in people and vehicles. And then if that person is in an area that the camera can see that they're not meant to be in, then it takes a whole bunch of actions. And some of those actions can be speaking to the person, hey, you're not meant to be here, we're calling security. It can then be also streaming, lighting them up with a floodlight. It can be streaming data to the cloud, where it's storing this information and it's notifying either yourself. You're sitting here, listening to reruns of this presentation. You've got an alert on your phone. It says there's someone here. You're immediately able to live view it and see there's 2 young fellas in hoodies. On an advanced model, you can click on a button and say, hey, you 2 guys with the hoodies, I can see you, better get out of here. Or it might actually be connected to a third party, which for security might be a security guard who'll go out there and have a look. So that's kind of how the ecosystem works. There's many other applications, but it's a combination of edge type behaviors, sensing, thinking, and acting, and cloud type behaviors of sensing, thinking, and acting as well. It's a fairly unique platform. I could spend the next 20 minutes just talking about how it's special, but to go through it fairly punctually, these systems are more than just a camera. They sense, they think, and they act. Our ability to actually do artificial intelligence, our own and other people's, both edge and on the cloud, make them a very useful platform, and their ability to take an action, whether that action's open a box, send a message, speak to someone, turn on a light, or it's something that's cloud-based action. We can do those things as well, and all without people. The systems, again, they're completely wireless. So they run, all of our new models now run on lithium batteries with solar. So very, very reliable power systems. You can put them wherever you want. You can have a system up and running in an hour. It's one solution, so you're not trying to integrate different pieces. We will provide you a complete solution in the ground, or you can install it yourself. It's one app. It's one web device. It all works together. There's no jumping between different applications or devices. We have written the software from the very start, right through from the edge device all the way through the cloud software we have written. We've also designed the electronics, so it is a fully integrated solution, but it's designed to be modular and bring other people's things together, which also makes it quite unique. So we can use other people's cameras or other people's AI or other people's sensors and just plug and play. And we do all that from our Australian team, which again is quite unique. And because of that, we are able to work, for example, on Department of Defence bases, because there's no risk of our data being streamed to foreign countries. So that's kind of the business. They're the sort of things that we do. I'll explain a little bit more about some of the other applications as we go along. What does it look like from a financial point of view? We sell devices, so that's hardware. That makes up about 1/3 of our business revenues at the moment. We have a recurring rental stream made up of subscriptions for everything we sell, plus our rental fleet. That's making up about 57% of the business at the moment. And then we have services, which is either professional software or it is, physically install it, move it, repair it, and the like. And we are growing very aggressively at the moment. What does that look like? We had a little bit of a lull through COVID. That was no fun for many people, but now we're absolutely off to the races again. If you look at our year-to-date revenue over the last few years, this is September year-to-date. I can assure you October is going to be better again. Really showing great ongoing growth in revenue, and you compare that year on year, the sort of growth that we've had. Spectur's a proven business. We're not a twinkle in the eye. As you can see, some of these numbers here, more than 600 customers, more than 2,500 systems deployed. And, we've got out of the way of ourselves through COVID. We've got our momentum back, and that's resulting in, a very substantial, so what we've done is showing growth, and what we've got in front of us is showing growth. So if you have a look at the pipeline on the right, you can see through FY21, FY22 and into FY23, both weighted sales pipeline and unweighted pipelines are both substantially up on where they were this time last year. So we've got a lot more in the hopper. If you look at what we've actually sold, again, down the bottom chart, these are our September sales. So not revenue. Sales can include immediate revenue, but it can also include rental that's longer term or subscription that's longer term as well. So there is a correlation, but it's not direct between sales and revenue. But really, this points to future near-term revenue. This points to a longer-term growth as well. So every single metric says growing and more growth to come. The business is profitable, is got a high gross margin. We have had moments of profitability. We are converging. We did have a higher cash burn in Q1 because we did a lot of one-off things, including growing our inventory. I think we're at the moment 360 grand up from an inventory point of view from the end of last financial year. So we certainly told people we were going to spend money on inventory, and that we did, but that's obviously not continuing forever. Sales pipeline is strong. We're setting new sales records all the time. So again, it's really a growth story that we have at the moment. I won't belabor this slide other than to say, I think we're extraordinarily good value. And I continue to be what was a top 10 shareholder. I've just dropped out. I've been pushed out by others, but I'll be back in there soon enough, no doubt. There I am sitting down here. We also have our chairman of the board is sitting up here as well, and a lot of other great shareholders too. So where do you go from here? I mean, I've really only just touched a little bit on the opportunity for Spectur. When you have a platform that can sense, think, and act, and largely do the things that in many ways a person could do, but without exposing them to hazards, the cost of them, or the ability to get them in place, you just simply can't get people now. There's a whole range of different things you can do with it. And there's a whole range of different customers that can buy it too. So what we have to do is be quite focused. We can't be the fox that chases many rabbits and catches none. We've got to just pick a few. So we're trying to stay a bit focused at the moment. And so, to do that, we are looking at sort of fixed customer groups that we're really targeting. and fixed geographies that we're targeting at the moment. So if you look at what our plan is for this year, it's really about trying to dominate our current Australian market and get our product ready for really scaling up. So what does that look like at the more granular level? We're looking at getting on board some more resellers. Last financial year, we had about 16% of our business was resellers. This is how we're going to scale our business up in the longer term. Is we do have a sales team of about 6 people at the moment, spread around Auckland, Perth, Sydney, Melbourne, Brisbane, and now South Adelaide as well. But that's relatively capitally intensive when we fully integrate like that. So we're looking at how do we build out through resellers. And then we're also doing a bit of market testing, market research in the US, which is where I am today, just to see whether or not the uniques that we have are the same in the US and how attractive that market is and how we might enter it. So, but one way or another, we are trying to get our business ready to scale and build on the growth we have now and get that kick in the tail that takes the growth curve even higher, but in a less capitally intensive way. And so when you look forward into, after this year is we should look to see some of that scale of the resellers. Actually, one thing I want to go back. One of the things we're doing is around our product. And it's not that we're reinventing a new product, although we are going through some evolution there. It's more about designing it to be built at scale and designing it to have the plug and play modularity that we want that enables us to be very reactive to our customers and give them the things that they want in a way that is reliable and cost effective. So we've already proven customer product market fit. So we're not trying to change that a lot necessarily. We just want to make it simpler and easier, improve our gross margins, improve reliability and standardization and modularity as well. When we've got that ready, that gives us a platform that we can more comfortably and more reliably really expand our sales outside of our existing networks. And that's what we think the future looks like. A lot more resellers, both locally and internationally, moving towards online sales down the track as well for a subset of some of the things that we offer. And then moving into more sensing and AI as well. We've built our platform to be very modular for other people to bring their AI onto it. And we work with many different AI companies at the moment to deploy AI, particularly edge as well as cloud. And we're looking at making that simpler as well. So, my last slide before I hand over for questions. Spectur, we've got a fairly unique platform. In much the way that the people in the gold rush that made all the money were selling picks and shovels, that's where Spectur is as well. We're not an AI specialist, we're not a sensing specialist. We're creating a platform that allows people to deploy those things using a solar-powered system that isn't wired. So, that really creates an opportunity for us to develop our own solutions in the short term, but ultimately for others to use us as a platform to deploy their solutions. We've proven the business model. We've got more than 600 customers around the country, into New Zealand and elsewhere in the world as well. We don't think there's anyone quite like us at the moment. And what we do is very difficult because it involves electronics, design and manufacture, as well as software, both edge and cloud, which is quite a complicated group of skill sets to work with together. We don't see anyone in that space doing that in the same way that we are at the moment. We are well capitalized with a raise that we did a few months back, growing a great high margin product with recurring revenues, and every single metric we have shows strong growth at the moment, whether it's revenue, whether it's sales, or whether it's a sales pipeline. We've got a plan for growth, and none of it requires a cure for cancer, and an awesome team that I didn't get a chance to talk about, but trust me when I say that they are awesome. And I think I will take a breath and let's take some questions.
Thanks, Gerard. First one from the audience. Do you price your products differently depending on the industry segment? So if we're talking about large construction projects versus something for the Ministry of Defence?
Yes, is the short answer. I mean, we're not a pure value-based pricer. I think when we're in the construction space, there are more alternatives in terms of secure solar power security cameras. They don't work the same way. They don't do things exactly the same way, but there are analogs. Whereas a lot of the work that we do For example, in the defense space where we have few competitors, or in safety and warning, particularly beach warning systems where we have no competitors, we have done some bespoke things to make those systems a little bit different. Because of that, and that uniqueness and the level of service we provide in that space, they are priced differently as well.
And in terms of major customers, who would be people that, currently, at least anyway, might represent, 5% more of revenue?
Yeah, I mean, we've got a real spread of customers, as you can see, 600 plus. The big customers we have at the moment would be people like Optus. They're probably our largest customer with more than 100 systems. We have Department of Planning Labs and Heritage Western Australia. They've probably got more than 60 or 70 systems. We've got big constructors like the multiplexes and the John Hollands of the world. Local governments such as Lake Macquarie or Shire of Margaret River Augusta. Surf Life Saving New South Wales, Surf Life Saving WA. There's a whole range of people that are, substantial customers, and then a whole bunch of smaller ones. But what we find is with our customers, often the acorns turn into oak trees. They, particularly with newer technology, they'll come in and they'll maybe just rent a couple to start with or try them out. And then if they like it and it works and it does all the things that we say that it does, then they go back and buy more and more and more and more, which has certainly been the story for most of our larger customers.
One on the kind of sales channel or process, are your business development managers doing outreach, or is it more servicing inbound leads from marketing activity?
So it's all of that. We certainly do invest a reasonable amount of money in digital marketing, but we really need to do outbound as well. And because what we offer is usually a substitute to do nothing. It's our single largest competitor. And that means no one goes, when say if someone gets eaten by a shark on your local beach, people aren't thinking, what we really needed to do was to warn people when a shark was in the area. So I needed a solar powered platform that was connected to the tagged shark network, was able to warn people to get out of the water automatically when, they're not looking for that. So we have to go out and tell people these things exist, let people know that we've got a platform, that if you've got a campsite and you're worried about people when you stay there, that it's safe, and that someone, I've watched Wolf Creek too many times, and what happens to me on this campsite, and we can say, well, we've actually got a solution that gives you connectivity and communications and perhaps photographs and gets a license plate of every vehicle that comes in and out and timestamps it. And, you've got to go out and talk to people. So that's why we do have a good sized sales team, because we can't just rely on inbound and we can't just rely on account management. We've got to go out and tell the story. We need missionaries.
And then one for me, in terms of, reseller partners that you want to engage with, work through, what type of businesses are they generally? Is it solar focused businesses that can, sell this as an add-on to their existing solar business, or security companies that, can offer this as an add-on to their business? What kind of business is a typical reseller of Spectur products?
Well, today it's the latter. It's security companies. They are looking to have an edge, and it gets quite competitive if you're just in guard services or patrols and the like. So they will buy our systems and then they will on rent them to their customers as part of a combined, camera guard response solution. So they're our largest resellers. We also have some of the companies like Kennards. Large hire companies. They're increasingly taking on board Spectur solutions as well. So there are the general hire companies that use them too. I think over time, we'll be looking at how we might go into some of the larger electrical wholesalers potentially, and even an online model as well. So we're exploring that at the moment to get the right model. We are the only people that have a fully integrated solution. But to what degree do we need to integrate it for those customers, and how does that vary? I think we're still exploring that at the moment. But this is a very much an untapped vein that we're quite excited about.
Yeah, I think maybe a follow on to that point, Gerard. The next question: how bespoke is your product, or for different customers, and would this be an issue for reseller partners? And maybe if I can just tag on to the end of that question that we've got. How much customization goes into doing something for Optus versus doing something for, Surf Life Saving New South Wales? Is it more on the programming software side, whereas the hardware is pretty much standard across customers?
Well, what I would say is that probably 95% of our customers get one of our standard models. To be fair, we have a range of different systems and solutions that we offer. 95% of them are standard. I think for you mentioned two of our larger customers that have very specific needs. I think it's a combination of cloud and and edge and hardware stuff as well for both of them. I think if you look at Surf Life Saving Western Australia, for example, they want to have a signboard. Surf Life Saving New South Wales, they want to have a two-way phone, but they don't want the signboard. So there's different combinations of hardware. Again, some customers want us to integrate the whole phone system through, so that all they have to do is answer it. Others are happy to manage that side themselves. So because we have in-house hardware and software and cloud engineers, we're able to respond. But generally, it's for larger customers. If it's substantial, we'll charge an engineering fee for that. Or if it's a really large order, we'll just wrap it into the design and as well. And then over time, we will add that feature to the rest of our customers as well.
Okay. And as I mentioned earlier, you're dialing in from Los Angeles, which I appreciate. You're in the middle of a US trip. That US trip, just give us, are you over there looking for, interesting AI partners or potential resellers, or looking at, competitors who maybe do something exclusively in the US market, maybe not internationally, that is similar to you, or maybe going in the same direction? I just trying to understand, what the US trip is hoping to achieve.
Yeah, so it's very much a research trip at the moment. Our focus right now is very much around dominating our local markets, certainly in Australia and New Zealand. But like, a lot of strategy is you have Horizon 1, Horizon 2, and a Horizon 3. And in our future horizons, we see an opportunity in the US. And so what we're doing is our research now I want to test customer product market fit. I want to understand why does everyone in America seem to use a trailer? Why aren't they using them in ground the way we are? Why is it that no one seems to have the fully programmable edge AI, and they all want a closed system? Or is there someone out there that doesn't have that? So there's, understanding what does the reseller market look like, which states are more lucrative than others. There's a lot of research that I'm looking to gather in a series of trade shows that I'm attending over the next couple of weeks. That will go back into a plan around how we might, if, when, and how we might enter into the US. But this, certainly trying to manage expectations. We do not expect to be in the US this year or next year, probably either. This is about planning for that and being ready for it. Because the worst thing you can do, having lived and worked in America before, in fact, in many other countries as well, going overseas is very expensive. It's very easy to fail and get it wrong. And so I'm a great believer in forward planning, and that is exactly what this is.
Okay, great. Let me just check if we got another question here. And I think we've answered all of those. And Gerard, if we can just touch on, I know you mentioned it briefly at the very start, you're now using the lithium batteries for a bit of extra shelf life. What is in the pipeline on an R&D front to enhance what you've got and kind of keep you ahead of any potential competitors?
Yeah, so I mean, the lithium does quite a bit more than the shelf life. What you get is a much more stable power delivery than you get from a lead acid battery. And you also get, believe it or not, greater sensitivity to heat. People are always frightened about the heat, but they'll actually survive a lot longer and perform a lot better in higher temperatures than a lead acid battery will as well. So we've got a modular power system that we're looking to bring out shortly. This thing is initially going to be a plug and play with our technology platforms, but ultimately it could be used to power other things as well, whether it's a Wi-Fi router or a satellite connection or a lighting system or the like. So we're expecting to have that out in Q3 of next year. We've got our Star 6S platform we released in September, which is a midlife refresh of the one that you can see on the screen at the moment. That system effectively is our first foray into using modular camera systems rather than the bespoke internal camera design. At the moment, we've got 3 different camera types we're working on, including license plate recognition. And what that allows us to do is to really respond to customers that say, I want to have an ABC camera. It's part of my specification. And we can say, all right, well, you can have the ABC camera, but you can also have all the other benefits that you get from Spectur in having that, whether it's the AI or the ability to have multiple cameras on one platform, which we can do because of our power. And then I guess the other things that are coming is certainly more AI, looking at deploying other AI solutions and more sensing. We've spoken a little bit about it in the past, and we tend to be more famous for our camera work, but we've got some pretty exciting opportunities around alternative sensing that we've got around the corner, and look to share that with them in probably the second half of the financial year.
Okay, perfect. Gerard, we're just perfectly on time there, so I'll say thanks once again for joining us, especially on the road. It was great to hear the Spectur story firsthand. And I do know we have Kate Quirke, our second presenter, standing by in Melbourne. So Gerard, if I could ask you to please stop sharing your screen, and we'll hand over to Kate. If you want to start sharing yours, I'll let you know when I can see your slide deck coming up. Yep, I can see the cover slide now, Kate. You can take it away.
Thanks very much, and thanks everyone for joining. Before I get started, I would like to acknowledge the traditional owners and custodians of the various lands on which we work and meet today, and pay my respects to their elders past and present. The history, culture, diversity and values of all Indigenous people are recognised, acknowledged and respected. Thank you very much for inviting me onto this today, and for everyone's interest. My aim is to give you a little bit of an overview about who Alcidion is, the industry we work in, some brief financial highlights from our first quarter, touch on a little bit on FY22, the growth opportunities and where we are heading in FY23. So for those of you who are not familiar with the company, today Alcidion is an international, well, not yet what I would consider fully global digital health company. And we're really focused on using data to transform healthcare and healthcare delivery. We have about 190 staff spread across Australia, New Zealand and the United Kingdom. We've got a broad investor base made up of around 20% institutional investors, 30% founders and directors, and 50% retail investors. Really, what we do is aggregate all of the data available in healthcare systems and centralize that in our Miya Precision platform. And we use that data to then support doctors and nurses in their clinical decision-making. And the boxes above the Miya platform are the modules that we provide, so customers can buy our platform or one or many of our modules. And we actually have recently, well, not so recent now, nearly a year ago, did an acquisition of a patient administration system out of the UK, company called Silverlink, which provides us a lot of the data feeds into our Miya Precision platform so that we can now provide a full electronic patient record, particularly to the UK market, which is a significant opportunity and increasingly a market where we're seeing significant revenue growth. Essentially, our aim is to create a safer clinical environment and a more efficient one through the application of algorithms and what we refer to as augmented intelligence, as opposed to AI, in the sense that obviously doctors' decision-making experience and knowledge also needs to be able to apply in the delivery of healthcare, so we don't take it over fully. We have seen significant growth in the UK over the last 2 years as that market has begun to invest more and more in the modernisation of the UK NHS. I'll talk a little bit about the differentiation of the opportunities between the UK and Australian and New Zealand opportunities as I progress. A little bit about what we do. So as a company, we continually are looking for challenges and trends in healthcare to see how we can use the platform that we've created in My Precision to improve patient outcomes, promote safer clinical environments. Over the last 3 years, we've obviously witnessed several important shifts in global healthcare, and that's helped us to really focus our attention. Some of those challenges are around significant strain on healthcare as a result of the backlog of the patients that weren't able to be treated during the pandemic, but we already had an increasing demand on the healthcare environment in terms of ability to treat patients, particularly with an aging and more complex healthcare environment. We've got an increasing demand for digital support for hospital in the home or remote patient monitoring, and I'll talk a little bit about that. And then we've got increasing volumes of patient data that doctors and nurses want to use to support their decision making. And so at our industry level, we've seen a strong shift towards digital solutions within the healthcare sector, an increased level of support for funding for digital solutions, particularly in the markets that we're operating at the moment, and I'll talk a bit more about that, and a growing demand for more modular, interoperable and innovative workflow solutions, as opposed to some of the market players that have been around for some time, some of the big American monolithic players like Cerner and Epic. So we position ourselves against those by being able to sit on top of existing investments in healthcare and in digital, or we can in fact be the electronic patient record, and we're seeing more and more interest in Alcidion in that in the UK market, where they're looking to modernize but not necessarily go down the path of the big American vendors. In all cases, I think the key point of differentiation is that we add value to the already considerable investment that they've made in digital health. We're not looking to replace an incumbent, but to add insight and further engagement to that data. So, in terms of our differentiation, we provide a modular cloud native offering. It's new. It's kind of like 3 or 4 years out of the block. We're still continually developing and enhancing that solution. The contracts we have are committed recurring revenue, usually for an initial term of 3 to 5 years, then with annual renewals or multiple renewal periods built in. So it's a very sticky business as well. Once you actually have engaged and implemented your solutions, you don't see a lot of churn in healthcare. So there's a lot of the characteristics of the market that we are operating in. In terms of how we're positioned, I think I've touched on a number of these things in this slide: cloud native, long-term contracts, strong financial profile, and increasing market tailwinds in this sector. I thought one of the things that's often makes it easier to relate and understand what we do is to perhaps touch on a couple of the examples of things that we've been working on. In 2020, the COVID-19 pandemic caused the abrupt closure of offices, obviously, around the world, but it also forced hospitals and healthcare organisations to look at how they could treat more patients at home to keep their staff safe and the patients safe. And so virtual care and remote patient monitoring, which had long been recognised as possible alternate models of care that we could use as a way of reducing the burden on the healthcare sector, really they then came into reality. And the outcomes for patients are proven, and there are many studies that have demonstrated that patients are happier. But just before COVID, we'd started talking with Sydney Local Health District, one of the leaders in respect of virtual care delivery in a truly sort of virtual hospital sense. They created RPA Virtual, which was their approach to how they were going to support models of care delivered outside of the walls of the hospital. And they initially looked at starting with chronic conditions like diabetes, but when COVID arrived, they had to shift fairly quickly. And at the same time, Sydney LHD recognised that their existing IT systems weren't set up to manage patients remotely, and yet their existing systems had all of this data in there that was really valuable. And so they looked to Alcidion and My Precision to be able to provide a tailored monitoring dashboard initially that was very focused on patients with COVID and returning travellers who were in quarantine, and where we could use devices to actually monitor those patients and feed the data into a central location that was RPA virtual, and doctors and nurses sitting at their dashboards could monitor those patients, identify patients that were deteriorating, contact them via video conferencing, and advise on their care. And so it started there. Then Sydney have now rolled that out to other conditions. We're starting to do some work around diverticulitis and going back to looking at those chronic conditions as well. Similarly, we were doing work with Murrumbidgee Local Health District in New South Wales. And in this case, Miya Precision had been deployed in the ED department and was being used to provide mobile information and help with the rapid treatment of patients in ED. And so because the platform was deployed, we started to look at how that could support hospital in the home. Murrumbidgee, and a really great example that was part of a case study, was an 80-year-old woman who'd recently had a heart attack and had been in hospital, had gone home, did not want to go back to hospital again. The family said, look, when she was in hospital, we weren't allowed to visit her because of COVID. And, that really didn't have a very positive outcome for her. So respecting those wishes, the doctor instead admitted her to hospital in the home with a monitoring armband, which you can see in this slide. We don't provide the armbands. We basically can take information from any devices that can provide it. But that was a good example of what Murrumbidgee was using. But what Miya Precision is doing is providing this virtual care dashboard that tells us about all the patients that are being treated at home and constantly feeding data into this monitoring area of the patient's temperature and respiratory rate. And then we have algorithms in the back of this that are identifying all the time patients that are potentially deteriorating. And then the patient can also use an app to capture information. We can send information to the patient about what they need to be doing, and they can add in their symptoms and so forth. What happened in this instance was that the doctor could see that this patient's respiratory rate was deteriorating, organised a video call, assessed the patient, decided they needed to do a home visit, went there, adjusted their medication, patient stayed at home, and the outcome for everyone was far more positive. And that was really that is assisted and aided by the information that Miya Precision is capturing. Another area we're seeing a lot of interest at the moment is around patient flow. How do we more efficiently move patients through the system, because we have so many patients backed up in terms of wanting to get into healthcare and hospitals at this point in time. And so what our flow module does is an application, again, using the data that's in Miya Precision. It provides hospital management and clinical teams with the information that they need to real-time manage the patient stay, so they can see what resources are being used, what's holding up the patient from moving through the system. So we have a waiting for what capability. So are they waiting for medications to go home? Are they waiting for a physiotherapy consult? And all of that information is presented on these dashboards, which can be seen at a ward level, but also can be seen in the command and control centre. And already this year, we've seen a lot of uptake of our patient flow management solution in Australia and the UK, with multiple hospital agreements signed. And with the Alfred Hospital here in Melbourne due to go live this month, we're looking forward to seeing the feedback from them as well. This slide here gives you a snapshot of the activity over FY22. I won't go into all this detail because there's a lot of information here about the different contracts that we signed over the prior financial year, but more detail on each of these can be found at our website. What it's really saying is that we are experiencing increasing growth and new sales and increasing market presence across all the geographies that we're working. The healthcare industry continues to need access to smart, innovative technology to address some of the challenges in healthcare. And we've been really pleased to see the momentum and also the impact that that's having on our growing pipeline now as well. At the end of Q1 of this financial year was one of our strongest in terms of cash receipts, up 83% on the prior corresponding period. That flows through from having a very good and strong Q4 in terms of new sales. Certainly FY22 was a very good year in terms of total contract value. We signed some of our biggest contracts ever in that financial year. We start the year with a very healthy 29 million in revenue able to be recognised in this financial year, with a further 2.6 million of renewals. So even if we sold nothing else, which will not be the case, we're strongly ahead of where we were at the same time the prior corresponding period. And we certainly in the first quarter we had a slightly negative operating cash flow, but that's a significant increase over the position we were in Q1 of the prior corresponding period. So that demonstrates how the business is moving healthily. We certainly in FY22 were cash flow positive and underlying EBITDA positive, and we plan to be equally cash flow positive and EBITDA positive in FY23. Q1 is generally a slower quarter for us, but also one with larger outgoings. So in Q1, we often have especially if we've had a good Q4, we're paying a really reasonably significant amount of VAT and GST in respect of outflows. It's also when we pay out bonuses and so forth. So we often see Q1 in this sort of area, but we have got a significant improvement on the prior corresponding period. We have a very strong cash balance of 16 million and no debt. A little bit about the growth opportunities for us and the drivers. As we have moved solidly into FY23 now, it's hard to believe we're getting towards Christmas. Our focus has remained on our three key growth drivers, and that's new contract wins, which build our long-term TCV from a recurring revenue perspective. As I said, most of our contracts are 3 to 5 years in length, and so they contribute to increasing each year on year, the contracted revenue. We are modular in nature, as I touched on, and so very much, and this has been demonstrated by a lot of our new contract wins, we're about upselling additional modules into existing customers. So we have a 27-28% presence in the UK, for example, of one or more of our modules, and so really focused on going in and selling additional modules, and of course ongoing contract renewals. A little bit about the UK, which is a very strong opportunity for us. As I previously mentioned, we have seen significant growth over there, but now we've also seen that the UK has announced a further significant funding stream and a program of work where they're looking to get 90% of the trusts to have procured an electronic patient record by December 23, and 100% of them live with one by 2025. And we're really well positioned with our Miya Precision platform and the acquisitions that we did through 2021 to be able to be really competitive in this opportunity that presents itself. And so that's mostly at a trust level, but we're also seeing this emerging opportunity in the UK that sort of increases the addressable market as the regional trusts are being brought together under the banner of an integrated care system. And these ICS or integrated care systems are looking at how they can share data and view data across trusts so that they can more efficiently manage patients. And we have, currently there are 42 ICSs in England, and we have one or more of our products in 20 of those. So a good presence in respect of that opportunity as well. I touched briefly on the acquisitions we did in 2021. That was really to fill out our offering so that we could be competitive with a modern modular electronic patient record in this UK market opportunity. And that one of the significant acquisitions we did in December late of 2021 was the acquisition of a patient administration system that's represented by the boxes below the Miya Precision platform. They're feeders into the Miya Precision platform, and they've really positioned us to be able to actually compete and respond to tenders in that market for an electronic patient record. In terms of our presence in the UK, we ended FY22 with at least one product in 39 trusts, which is about 27% of all NHS trusts. And as I said, nearly one in around 50% of each of the ICSs. So we're really well positioned. But you can see from this that, a lot of that is in our modules where we have 1 or 2 or 3 modules in play, not we're only beginning our market opportunity in respect of Miya Precision. And as you start to see customers engage with us to buy now the full EMR and the full Miya Precision capability, the value of those contracts increases over time. Not to say that the modular nature and the upsell of these individual modules isn't very significant, is contributing to our ability to have a pipeline that is made up not just of full integrated EPR opportunities, but the smaller opportunities that are $2, $3, $4 million in value. And obviously, 5 or 6 of those makes a very significant impact on our recurring revenue profile. In Australia, where we have a stronger presence with Miya Precision, we also have a strong presence in a lot of the health services in Australia with our services capability, where we provide support in the integration space and the collection of data and in data and analytics. And all of that positions us well to be having conversations with customers around the opportunity that Miya Precision can also present for them. New Zealand has typically been a strong market for us with our Patient Track and Smart Page solutions, which are modules of Miya. We have our first Miya Precision deployment in New Zealand, and we've just seen a major reform of the New Zealand health system. And we think that's going to present good opportunities for us given our presence in that market. So looking at outlook from here, we have several points of differentiation from our competitors that really do set us apart in the market. We're very, sorry, I was going to touch on outlook first before I do differentiators. As I said previously, we are very strongly positioned at the end of Q1 in terms of revenue able to be recognised, and that's without us actually making any more sales. And I touched on the fact that we've got a very strong pipeline at the moment and expect and have a number of opportunities in contract negotiation. So with contracted revenue up significantly on the same time last year and several near-term pipeline opportunities well progressed through contract negotiation stage, we are confident in our ability to meet our expected target of being cash flow and EBITDA positive in FY23. How we're going to do that very much is around the differentiators that we have established. Not only are we able to provide digital solutions that address a lot of the challenges that emerged during the pandemic and are in play today, but we have created a smart healthcare infrastructure platform that supports a number of other challenges and emerging challenges, and can actually deploy a number of algorithms to address some of the really key challenges that the healthcare system is experiencing today. With the acquisition of a PAS solution, we are strategically positioned to expand our UK presence within the next 2 to 3 years as our modular product approach attracts increasing interest, given the UK's clear focus on improving digital maturity in a cost-effective way, protecting their existing investments and not necessarily looking to the large US APR providers that have been more prominent in the Australian market. And that brings me to the final point. What Alcidion is providing is a modern modular digital solution that adds value to existing customers. So we don't require our customers to replace what they've already invested in. We sit on top of that, adding value to those investments and giving them a greater opportunity to achieve that return on investment more quickly. So I think with that, I'm happy to hand over to questions.
Thanks, Kate. I might just get the ball rolling here. Acquisitions have been a part of Alcidion's growth strategy in the past, and I know you've got 16 million sitting on the balance sheet. Should we think about acquisitions in the future, or is the Silverlink acquisition kind of put you in, I guess, a neat part of the puzzle where you've got all you need now, and it's about selling that solution into the various markets that you operate in?
I think the latter is where we're at the moment, Mark. We've made that investment, and we're very comfortable with the offering that we're now taking and the market's receptiveness to that. So certainly it's not high on our strategic agenda, and we're not actively going after any new acquisitions. That wouldn't discount if something came along that looked very attractive and made a lot of sense strategically, but it's certainly not an active part of what we're doing at the moment. We're happy that we have an opportunity now and a good offering in that market, and an addressable market that is very attractive.
And on the NH trusts, or maybe the ICS might be a better term for them these days. How often do those come up for tender? You know, what's a typical contract length, either for your contracts or for other people's? And, you know, is there some out in the market that you're currently bidding on?
Yes, that's a good question. As I touched on, the frontline digitization program means that there are a number of trusts in the market at the moment at various stages of procurement. And we are involved in some of those. So it's quite active there quite right now. Funding is still being finalised to a number of those trusts. So it's a little bit behind, I think, their timeline. But yeah, definitely those discussions are going on. The contracts are typically 3 to 5 years, but anyone who buys an electronic patient record, once they buy it, is going to renew for longer than that. It's just the nature of historically how that happens. But typically 3 to 5 years initially, with options to extend.
Okay. And I just want to get an understanding of FX risks or not in the business. In terms of the UK revenue, how much of it is kind of offset by direct UK costs, and, you know, what would be, you know, the net exposure of, you know, the Australian business when you translate it back?
Yeah, good question. I mean, to be fair, you know, a lot of that is offset because money that they pay in the UK, we necessarily keep in the UK, we pay out in the UK. So to a lesser degree, there's a less amount that's being transferred back and forth between Australia and the United Kingdom. So we keep an eye on it, and it's been a bit swings and roundabouts in the last few months. Certainly, if there was any significant sized contract where we felt we needed to look at, you know, hedging the foreign exchange to smooth out any potential risk, our CFO Matt is quite focused on that and is across that. So we are keeping an eye on it, but at the moment we're able to manage that in terms of where the costs are lining up with the revenue.
And in terms of costs, a major one for pretty much all the businesses, I think, in this conference over the last 2 days are R&D and, you know, updating the current platform and, you know, responding to what your customers want. How do you think about R&D? Do you look at it as, you know, a percentage of revenue on a kind of annual basis, or is it more, we'd really like to do this and we think, or we know that our customers would want it, and you attack it, I guess, from on a project by project basis?
Look, it's more the latter. We definitely have a program we have a team of people. We identify what we want to deliver, and obviously we're not planning to continue to grow that team. So where it's at now is where I expect it will be. So that will define in some respects how much new and additional functionality we continue to deliver, which is still quite significant. That team is producing a lot of new modules, and if you just look at what we've produced in the last couple of years, plus the work we're doing for ADF, that R&D team is producing quite a bit. We're really at a point now where we have invested to scale the business. We've invested for growth, not only in R&D, but we've obviously invested in our back-end systems and capabilities. So that as growth continues to kick in well into FY24 and FY25, we'll start to see greater operating leverage, increasing profits as we go forward.
And then maybe just like one final question. Obviously, this big digitization push in the UK is a great opportunity for Alcidion, but should we still expect good growth from the Australian market, such that, you're roughly half and half between the two markets. It might swing in roundabouts from one half or one financial year to another, but even after you capture a fair share of what's coming in the UK, should we still expect, if we look at Alcidion 3 years down the line, that it'll be roughly a half business in terms of revenue, etc.?
Good question. My anticipation and the way in which we're looking at things is that the UK will probably become a greater portion. Hard to predict absolutely accurately, but that's where we're seeing it at the moment. There will still be significant contribution from Australia as we see this shift towards hospital in the home and a focus on flow, I think. And New Zealand as they increasingly digitise and move to electronic patient records. But we also are now looking at geographical expansion. Where do we go from here? I've recently done a couple of trips into India, and Austrade is doing a lot of active work with digital health into India. We certainly are looking at Southeast Asia, North America. And so while during COVID, we've sort of put the idea of geographical expansion on the back burner, we're now looking to, where do we go to next as well? So big opportunity in the UK that we're prosecuting, but also looking over the horizon at the next one.
Okay, thank you very much for coming back in and giving us an update on all things Alcidion. It's been a while, so great to hear the story firsthand once again. And we'll keep an eye out for further updates on the ASX. Thank you very much. Appreciate your time. Thanks, everyone. Thanks, Kate. And we will basically run around the park now from South Yarra, where Kate is, over to Albert Park for Paul Gillespie and Richard Ludbrook, who are joining us from Smart Parking. Paul, if you want to start sharing your screen, or maybe Richard is driving the slides, I'm not sure.
Yeah, I'll do that. Bear with me 1 second.
And interesting, we've got two businesses following on from each other. I didn't plan it this way, with a big UK exposure and a big Australia exposure.
Absolutely. Can you see that okay, Mark?
Yeah, the cover slide I can see now, Paul. It looks perfect.
Lovely. Okay, do you want me to just crack on?
Yeah, you can crack on, mate.
Lovely. Thanks very much. Good morning, everybody, and thanks for joining us. As Mark just said, I'm in Melbourne, or Albert Park office. I'm joined by Richard, who's actually based out of our Auckland office today, and he and I will take you through some slides that we lodged with the ASX pre-market this morning, that I hope will give you a good understanding of the smart parking business, our past performance, our commercial model, also Q1 updates, and our plans for the future. And after that, I'll be very pleased to answer some questions. Anyway, let's kick off with slide 2. So first of all, who are we? Who's Smart Parking? Well, we're a proud Australian company headquartered in Melbourne who specialise in the delivery of technology-led parking management solutions. We've developed our own proprietary market-leading technology that provides parking management services to landowners, property agents and retailers in order to effectively manage their parking locations or sites. I'm pleased to say that having proven we can build a successful and profitable business in the UK, we're now leveraging our IP into new territories with large market opportunities, particularly APAC and Germany. Our value add is, through the use of our technology, we can increase compliance, revenue, and customer experience for our clients. We know how to do this well and have deep experience and expertise. We have an attractive financial model that delivered FY22 results of $8.8 million of EBITDA, an increase of 296% on PCP, and at balance date on the 30th of June, cash on the balance sheet of over $10 million, and we're free cash flow positive, which is pleased to say. We move on to slide 3. This details our successful growth track record, but also the resilience in the business to recover quickly from the pandemic, where lockdowns impacted the number of cars using the car parking sites that we manage. However, it's clear on this slide that we're a growing, profitable, cash flow positive business with a strong balance sheet. The key points to note on this slide are the disciplined execution of our organic growth strategy that leads to a growth in revenue, profitability, and free cash flow. You'll notice there's some seasonality in the business in Q3, being the quiet quarter, if you like. This is due to Q3 being the UK winter, where car volumes naturally drop due to inclement weather conditions. However, As we grow our APAC business, we expect to see this even out across the year. On to page 4. This slide shows the growth in sites under management at September the 30th, or at the end of Q1. Our vision and long-term growth strategy, growth target, is to have 1,500 sites under management by June 2025. Given the regions we're currently operating in, we believe there's a total addressable market of 150,000 sites available to manage with our technology. Given we have 900 sites, we're at the start of a long-term growth runway, and we're well over halfway to our 1,500 site growth target. We added over 300 new sites in FY22, and we completed 2 acquisitions, which I'll talk more to later in this deck. We've also added 77 new locations across our APAC business, which is going well and is on track to profitability and being cash flow positive. So how does it work? Well, as I pointed out at the top of the deck, our value add is to increase compliance and revenue for site owners, whilst at the same time providing a seamless experience for the consumer. We know how to do this well and have deep experience and expertise within the parking management industry. The solution is actually quite simple. When a car enters a site that we manage, our technology will read the number plates on the entry and again on the exit. The technology will check that plate against the site's pre-programmed business rules, and the technology will also check the system for a payment, a permit, or a whitelist entry. If the car is not paid, has overstayed the parking time, or is not registered as permitted in that particular car park, the technology will then query the vehicle license agency database. We pay a fee to access the name and address of the driver, and then we send them a parking breach notice in the post. The secret sauce, or the IP, or the differentiating point we have, is the integrated technology system and industry-leading reputation for governance and compliance. When the system is installed, we increase compliance, which means our customer is happy as they're generating a higher footfall through the facility and growing revenue. We free up space in the car park by increasing the turnover of cars, so the consumer or motorist is happy as they can always find a space. And when a motorist doesn't pay or overstays the time allowed, we issue a parking breach notice or several notices, which keeps us commercially happy, which of course is all part of the model. If we move on now to slide number 7, or sorry, slide number 6, I'll actually pass over to Richard, who will take you through the business model, the ROI, and how we actually commercially generate revenue as a business.
Thanks, Paul. The model is incredibly profitable and generates a rapid payback. The commercial model varies slightly by territory, and I'll run through the metrics for a typical UK site, given that's where the majority of our sites are currently. We provide the equipment at no charge to the customer, and on average, the capex per site is £10,000. The capex includes cameras, signage, installation costs, and pay and display machines on some sites. The cameras and machines, which make up the majority of the capex costs, are depreciated over 5 years, and the signages and installation costs over 3 years, which is the typical length of a contract. And we retain ownership of the equipment. So each site on average will generate 70 to 80 parking breaches per month. The breaches are issued at £100 and are discounted to £60 if they're paid within 14 days. The average revenue per breach issued is £30.50, and that delivers revenue per site of £2,300 per site per month. The cost of sales is £7 per breach, which includes querying the database to get the driver's name and address, the printing and postage of the breach, transaction costs, and in some cases, debt recovery costs. Typically, overheads on incremental sites increase by 10% of the incremental revenue. And this delivers an incremental EBITDA margin of 60 to 65% and a payback of 6 to 7 months in the UK. The payback on a typical New Zealand site is 4 to 6 months due to sites yielding a higher number of breaches per site. In Queensland, the payback is 10 to 12 months, and that's due to the higher cost to obtain the owner's names and address in Queensland. So assuming sites generate similar metrics to the current estate, 1,500 sites will generate annualized revenue of $70 to $75 million and an EBITDA of between $22 and $25 million.
Thank you, Richard. Also on this slide, I mentioned in the previous slide, is around the customer benefits. The key thing really for our customers, if they are a landowner, they own a hospitality venue, they own a retail environment, whatever it may be, their key focus is to ensure there's always space for genuine customers to park. And so by implementing some kind of parking management that has an enforcement element to it, like we provide, you always have that, that availability of space for genuine customers. You see an uplift in footfall, which of course for them, for the customer, generates more revenue, a reduction in parking abuse. And of course, by having a technology-led solution with no people involved, then there's no confrontation with a traditional parking warden or a parking attendant. We can also, through the technology, provide a portal to the customers that we call the hub or smart cloud and the hub, that allows them to see real-time parking information, so they can understand, what are the busy times in their car park, how many cars came through the venue that day, what was the average dwell time, and so on. So all those insights they can gain will allow them to run different events and allow them to run their business more effectively. So essentially, it's all about generating space, generating higher footfall, and of course ends in more revenue for them and a customer experience which is better for them and also their customers. Looking at slide 7, having proven the model in the UK over a number of years, we've been busy getting implementation in New Zealand, Queensland, and Germany to run the same model. Starting in APAC and leveraging our technology, we have first mover advantage in the territory and access to a conservative total addressable market of 5,000 sites across New Zealand and Queensland. Having started in New Zealand, we're already profitable there and are building scale. We're also building scale in Australia, and we've recently opened in Germany, where we have access to a total addressable market that's twice the size of the UK. As I mentioned before, in total, across the territories we operate, we have access to total addressable markets of close to 150,000 sites. We currently have 900 under management at the end of Q1. It's a long runway for growth in these areas alone, with scope for accretive and complementary acquisitions. Slide 8 shows the key highlights of the last 18 months. As I mentioned, we've been busy leveraging our technology to open up in new territories. However, we've been complementing our organic growth and expansion with accretive M&A opportunities by closing 2 deals in the last financial year. The 2 deals completed are both in the UK and bring different things to the business. The EPS, or Enterprise Parking Solutions acquisition, was great for us. It was the first one we did. It was a small business with 68 sites under management using similar number plate recognition technology. We were able to take it on board, make some synergies through the integration, and retain the customer base by converting them across to our own technology platform and then running it through our own technologies. The second deal, NE Parking, is quite different, as they had 517 sites under management, but manually managed using people or parking wardens. These wardens would patrol the car parks and issue breach notices by hand. For us, this is a great opportunity to upgrade those sites to our automatic number plate recognition technology and remove the need for the human interaction. Typically, we see a revenue uplift of 7 to 10 times when we implement our technology. It's worth noting there are many of these manually operated parking businesses across the UK and Germany. These present SPZ with a great consolidation opportunity, and we'll evaluate each one of these on a case-by-case basis. Let's move now to our Q1 and our Q1 performance and how we're trading today, how we have traded throughout Q1. So FY23 started strongly. The growth in sites is continuing, and at the end of Q1, we're already 7% up at balance date on June 30th. With the growth in sites, which is our lead metric, we're also seeing the growth in other lead metrics, in particular, the 26% increase on PCP in the issuance of parking breach notices. Both these lead metrics of sites and breaches contribute directly to the growth in revenue, up 21% on PCP, and even with the investments we're making in Germany, we're up 12% on EBITDA against the prior comparative period. We have a strong business in the UK despite recent volatility, and our new territories are performing well. We have the ability to self-fund our growth strategy And after the German investments, as I mentioned a moment ago, growth CapEx commitments and the buyback program that we've been running, we still have over $9 million of cash at the end of Q1. The results have benefited from a greater activity in the UK as we've moved on from the pandemic. But for me, these results show the disciplined execution of our growth strategies to add new parking management sites, expand our territories and addressable markets, make accretive acquisitions and integrate them well, that are driving the growth and earnings. They're strong results and a good start to the year. Talking more about our lead metrics, this slide shows the growth in parking breach notices across 3 financial years and also Q1 of FY23. This shows the discipline on the site growth coming through, and this then flows to revenue and the bottom line. Looking at Q1 on the far right-hand side, we finished the quarter at 178,000 breaches, significantly up on last year. Whilst the UK is performing strongly, it's pleasing to see our APAC business contributed 22,000 of the breaches also. I'm pleased to say this trend is continuing into Q2 and goes hand in hand with the growth in sites that we are also seeing. Moving on to page 12, I'll now pass over to Richard again, who will update you on our Q1 financials and our performance to date.
Thanks, Paul. So this slide shows revenue and adjusted EBITDA broken down by quarter. And this highlights the ongoing revenue growth and also the operating leverage, with the adjusted EBITDA increasing 27% compared to Q1 FY22, if you exclude the $370,000 investment in Germany, which will lead to future revenue and earnings growth. There has been an increase in the headcount compared to the prior comparative period to cover growth and activity post the pandemic, but also the investment into new territories. Despite this, the EBITDA margin improved from 27.4% to 28.8%. The group maintains a strong balance sheet and is well placed to fund organic growth and further acquisitions. The group spent $1.8 million on CapEx, which will lead to future revenue and earnings growth. CapEx is expected to increase in FY23 compared to FY22 as a result of the expected growth in sites across all 4 territories. The group continued the share buyback and spent $400,000 in Q1 at an average of just under 23 cents per share. Thanks, Paul. I'll hand back to you.
Thank you, Richard. So on to the final slide now, and I'll close my presentation with a few comments on our outlook and our key priorities for FY23. FY23 should be another year of strong, profitable growth. We're a growth company in high growth mode. It's not lost on anyone at SPZ that we have a technology advantage, experience, and a large and timely opportunity to expand across our 4 countries. We have a proven business model and a compelling value proposition for site owners. We've worked hard to grow revenue and manage our costs carefully through a difficult period, and will continue to mitigate inflation with efficiency. The benefits of scale are clear. We're committed and well advanced in delivering our 1,500 site global target by 2025. Our global sales team is focused on adding over 300 new sites in FY23. We expect to grow in all 4 countries, given that we have now firmly established the foundations for growth. We have a strong balance sheet to fund the growth CapEx and to support the installations with over $9 million of cash. So in conclusion, we'll continue our laser focus on executing our organic growth strategy, which has been successful to date. We'll continue to explore acquisition opportunities to accelerate our growth and enhance returns for shareholders. Concurrently, we'll continue to look for new operating territories where we can leverage our technology and expertise to facilitate our growth well into the future. Thank you for taking the time to listen. We can now open up for some questions. Mark.
Thanks, Paul. Yeah, questions have been flying in there as you and Richard have been presenting. First one we'll take is, can we get an update on the Gatwick contract, if you have one, or when you have any idea of when this project may proceed?
Don't have a great deal of update, to be fair. I mean, Gatwick have been, they've had a challenging time. If I guess if anyone sort of watches the news or sort of follows what they're up to, they've been obviously coming out of pandemic. They didn't do a great deal at all, and they only had 1 terminal open for some time, and they didn't want to commit to doing these projects during that period. However, they came out and then of course got totally slammed like every other airport around the world, and staff shortages and all kinds of good stuff, and stories in the Daily Mail about people queuing out the terminal onto the car park and crazy things like that. So they've had their hands full. So it's been we still have a good working relationship with them. We've actually been doing some additional work with them, number plate recognition work in their long-term car park. That's still ongoing. But the major project of the sensor rollout right now, we don't have a date of when that's going to go ahead, and which is obviously on one hand it's frustrating. On the other hand, is actually not too bad. We're pretty focused on growing our services business right now, and that's going very well, which we've just obviously spent a bit of time talking about. But we will get to that project at some point. But we'll be working closely with the airport to get that done.
And then the next one maybe might be for Richard, but Paul, feel free to take it if you think. The Germany sites that the company is pursuing, do we have a better idea now whether they'll be similar site unit economics as the current average for the group?
Okay, so in the UK, obviously the ticket is discounted if the person pays within 14 days. In Germany, it's a little bit different. So the tickets are €40, and every time you send a reminder out, you can increase the value of the ticket. The cost of sales is about €4 in Germany. So that's obviously, the printing and postage and inquiring the driver's name and address. At this stage, look, it's very early days and a relatively small sample in Germany, but we would expect the metrics to be, fairly similar to the UK in terms of payback.
I guess it's worth pointing out. I mean, the reason we're in Germany, Mark, is it's a huge market. It's also very early in its kind of evolution of number plate recognition technology. Still lots and lots of car parking companies that are manually operated, where they wander about and issue tickets by hand. So for us, whilst we don't have first mover advantage, there are other players in there with MPR technology. It's a big market, and it is competitive. There's probably about 4 or 5 other competitors in there with a similar offering, but nowhere near as congested or competitive as the UK, where we're clearly doing quite well. But for us, as Rich said, it's early days. We've got a good team in place. It's just about, it took us a bit of time to get New Zealand up and running, but that's now running beautifully and is, like I say, profitable and cash flow positive. Australia is scaling well. We've got over 50 sites in Australia now, so we're happy with that progress. So Germany, we see taking the same sort of journey, to be fair, and we're excited about where we can get. It's a great market.
And then regulatory issues, let's just touch on that. The new UK parking code, maybe just give a little bit of context to that, Paul, and where it is at now.
Yep, absolutely. So the parking code of practice is, just for anyone who doesn't know, is a new what's the best way to put it, way of working, or there's a few rules around how you go about enforcing private land. Okay. And which is very important. And to us, we've always supported the new code of practice, or raising standards, and that's what it was designed for. How do you raise standards within the private parking industry? So it was released back in February last year, and the changes they made were, there was a few changes just around how you an appeals process or an oversight body within the industry, which is actually a good thing, and we want to see a raise of standards, because for us, there's a lot of smaller companies out there who don't do that very well, and they don't adhere to the rules. So for us, this is perfect to actually get a bit more red tape into it, because we do that well, right? We understand how it works, and we don't mind a bit more red tape. However, what they did say at the same time, we wanted to change the parking fees, or the level of the parking charge notice. And originally they said they wanted to make it the same as a local government, which is lower than the current charges that we currently issue. Then they came out in February and changed it again and put a range of fees in, going from £50 up to £130. But it's quite convoluted and quite complex, depending on the type of car park, whether it be an invited car park or an uninvited car park or a permit holders only car park. So there's lots of different types of ticket to issue. So we saw that as negative for 2 reasons. Number one, it'd be confusing for the motorist. as to really what sort of car park are they parking in, how much they've got to pay, and if they do overstay, what is the enforcement leveraged against them. So that was what the key thing. It was confusing. But secondly, you would see a drop in the value of the ticket, which is obviously not good for us because that would impact revenue. But then there was also a third point, which is, that would be offset by the number of tickets going out the door. And if we look at sites where we have, because we issue tickets primarily £100 and they're reduced to 60 if you pay within 14 days. But we also have other sites where we issue tickets at a lower rate because goes hand in hand with our customer. And those sites where we issue at, say, £50, for example, and that gets reduced to 30 or 25 you pay within 14 days, the volume of tickets on those sites is significantly higher. So we also put this across to the government and said, you're just going to see more tickets go out the door, which is probably not good for the industry. And you're also then going to get a higher debt recovery element. There's also then going to be CCJs, all those sorts of things get to roll forward from that initial enforcement. So what happened was the government then withdrew the parking code of practice on the 7th of June last year. They're still going through they're talking about doing an impact assessment on the industry. What does it really mean by changing these things? So we're no clearer as to if anything's going to change or come in. The good news is, though, in the time this has been going on, the Transport for London have come out and upped the tickets for red routes. So if you park on a red route or you block a red route in London, the ticket's now gone to £160 from 110, I think. Same in Scotland. On-street parking enforcement has now been increased through the government there. So what we're seeing is, other areas, Scotland, Transport for London, increasing the kind of on-street enforcement levy. And I think that will have some impact on where the government sort of land on this. So, but for us, they've put this up a couple of times. We've challenged it, with great, understanding of the industry and pointing out what they're missing. They've taken that on board and they've withdrawn it. So at this stage, it's business as usual. They're not looking to change anything in the short term.
Yeah, thanks, Paul. There's a couple of questions around PBNs. Broadly, it comes down to maybe one for Richard this time. Reasons for lower revenue per PBN in the first quarter of 23.
Yeah, thanks. Okay, so there's a couple of reasons for that. So one is there were higher technology sales in Q1 last year. And then the other reason, obviously, we're expanding into these new territories. So in New Zealand and Australia, the average revenue per PCN is lower than in the UK, but they're still extremely attractive markets to us.
And then a question on Germany. The German sites, which areas of Germany are the sites opportunities currently situated? And is the second part of that question, is the vehicle registration data sharing regulated by each of the states in Germany, or is it a federal system?
So the sites right now, we've got a couple in Berlin, Dusseldorf. We just picked up one in Hanover. We've got they're kind of spread. I mean, we're actually our MD, our territory MD is based in Dusseldorf. So, and we've got a couple of salespeople there and a couple of salespeople in Berlin. So those kind of they're based around those areas, if you like. We've taken on another salesperson who's based further north, which is why I've got picked up the site in Hanover. But that's not a we're not really fussy about where they are, so to speak. We've got lots of opportunity in the pipelines, pretty fat and looking good. In terms of how it's regulated, it's a federal system, although I do believe there might be some changes we go into I forget the area now, Munich, Bavaria. So, but other than that, it's actually come down recently. It was €5 to access the keeper details. We've now got it down to €3.50. So, which is good news. But no, it's Germany for us. It's a big place, clearly. Big population, biggest population in Europe. but also, you know, the market from what we can see is twice the size of that in the UK, which is what we're excited about. And it's just getting, you know, like we had with New Zealand, quite frankly, in Australia, you know, setting things up, getting it going. There's always going to be some challenges and some teething problems along the way. But what we've got now is a pretty solid team who are out there knocking doors every day, doing the basics, and just trying to get these sites in and up and running. Yeah, supply chain set, which is good. Obviously, the debt recovery side of things is set, which is good. So now we've built the foundations. Excuse me. We built the foundations, and we're in a place now for growth. It's all about just getting the salespeople out there, knocking doors, and winning business. So that's where we're at.
Yeah, thanks, Paul. We're just about up on time. Unfortunately, we didn't manage to get to all of the questions. So you wouldn't mind just quickly going to the contact us slide, or the last slide, if people just want to reach out to yourself or Richard if they have questions we didn't manage to get through in the Q&A. I'll just give people a minute here now as we approach our next presenter to note down the email addresses here. And thanks very much for joining us this morning. It was great to hear the SPZ story firsthand.
No worries. Thanks, Mark. Thanks, everybody.
Thanks very much.
Please reach out if you've got any questions. All the best.
Bye-bye.
Cheers.
Paul, if you could, stop sharing your screen, and we'll flip from Melbourne to Sydney. And I do know that Rene Sugo from Symbio Holdings is joining us and waiting patiently in the wings. Rene, if you want to start sharing your presentation, I'll let you know when I can see it on screen. It should be coming through now. Yeah, I can see your cover slide now, Rene. You can take it away.
Great, thanks. And thanks for the opportunity to present today. Hopefully you can hear me, so all the audio is good.
Audio sounds perfect.
Great. Okay, well, I'd like to start with a brief overview of Symbio, for those of you that have not seen us before. Symbio was incorporated 20 years ago in November 7, 2002. So it's our 20th anniversary this month. We're very happy about that. Since then, of course, we've grown to 530 staff globally across 10 different countries. And Symbio is a little bit of an enigma, but we're behind the scenes an enabler of voice and messaging communications for over 600 service provider partners globally. And our partners are a broad range from domestic retail service providers selling our services here in Australia under their own white label brand in what we call a telco as a service offering. We also have partners that are Microsoft and Cisco certified who leverage our unified communications as a service offering for enterprises. And we also have some global tier 1 carriers and some of the really big global software and application providers who rely on our communications platform as a service product. And now I know that's a lot of jargon to get into it on the first slide, so I'll come back to our operating segments in more detail shortly and explain all of those things. But the takeaway there is that we operate 6.6 million phone numbers on our proprietary software platform and network, and we're carrying at the moment over 9 billion conversation minutes annually. And whilst you've probably never heard of us, chances are you've all recently used our services as part of our routine interactions with technology. And for example, Zoom is one of our customers, and we're all using Zoom today. So it's pretty exciting. A bit more about our capabilities. So Symbio, we operate a global tier 1 communications network. We also have domestic networks in 3 countries, being Australia, New Zealand, and Singapore. So with our global voice network, it spans over 100 countries, and we have 220 direct partnerships, allowing us to send and receive phone calls and messages to every corner of the globe. And this combination of multi-country tier 1 networks and proprietary global voice networks is very unique. And that's a considerable opportunity for Symbio to be a first mover in providing our services into these markets. So let's talk about our three business divisions, which I alluded to earlier. So each of our business divisions targets a different group of customers, markets, and products, but they're all very synergistic. So the first one there on the left is what we call communications platform as a service. So this business provides access to phone numbers, to voice calls, voice termination, and messaging. And it enables large software companies and service providers to build sophisticated voice services in local markets like Australia. Our second division is what we call Telco as a Service, which provides a marketplace of turnkey telecom services, enabling small local mum and dad service providers to offer a complete suite of services to their customers. And they often white label these services, and these mum and dad providers could be regional providers in regional Australia, for example, that are serving their communities and are using our infrastructure and products and services to sell to their communities. And lastly, we have our unified communications as a service offering, where businesses provide quick and easy access to our cloud-based enterprise infrastructure with partners like Microsoft, Cisco, and Twilio, and many other of those very well-established enterprise brands. So the key commonality between all three of these divisions is that they offer voice communications in one way, shape, or form, and that's all built on our own software and proprietary network. As you can see from this chart, our three businesses have been seeing very strong organic growth over the last few years. We have a very heavy focus on recurring revenue streams, and what we call our as-a-service model is a subscription-based model, which once integrated by our partners becomes very low touch, highly sticky, and critical to their ongoing business operations. And you can see that our KPIs there, which is enterprise seats or services in operation or phone numbers, the relevant KPI for each division, they're all growing at over 20% CAGR for the last 3 years organically. So it's a pretty exciting trajectory. FY22 was last year was a transformational year for us. So it's the year that's setting us up for success into the future. We actually spent a lot of time simplifying our business. We disposed of some non-core assets. At the same time, we delivered consistent growth in the core business, and we started making strategic investments for our future. So we ended the year having met our guidance expectations with a very enviable balance sheet there. You can see a $42 million cash balance. Additionally, we have a $60 million undrawn debt facility. And of course, this puts us in a very strong position to execute our new strategy. And talking about that strategy, it's all about expansion into Asia. So this strategy involves entering 5 new key digital economies in Asia, and those are Malaysia, Taiwan, South Korea, Japan, and Vietnam. And this Asian expansion strategy is a key long-term enabler of growth for us into the future. And this strategy has come about because of our partners, some of those brands that I talked about earlier. And these are all priority countries for them to roll out their products and services as quickly as possible. The business case for this strategy is based on us leveraging our existing technology, our existing partner relationships, and rapidly increasing the total addressable market, thereby rapidly increasing growth in phone numbers and subsequently revenues, margins, and profit. So I'll talk a bit more about the business case in a jiffy. I'll start going around the region and giving you an update on how we're going with the strategy. So Singapore was our first market in Asia, and we started it about 3 years ago. And it's been a steep learning curve for us going into our first Asian market. And we appreciate that those people following us know that our revenues are taking a little bit longer to build than we initially anticipated. But we're nonetheless very pleased with the progress being made and the level of investment and commitment shown by our partners in building new services onto our platform. We've now signed and onboarded 23 global CPaaS partners. And you can see from the logos there that we're talking to some very credible players who will deliver meaningful revenues to Symbio, as they have done so in Australia and New Zealand in the past. So we definitely couldn't attract this quality of partner if it wasn't for our proven track record and the valued relationships that we've maintained with these companies. In terms of our UCaaS launch, it's also proceeding very well in Singapore. We've now signed up 19 Cisco reseller partners and onboarded them to sell our products in Singapore. I'm very pleased to say we're actually up to 1,000 seats now, up from the 750 when we put this slide together a few days ago. So sales are picking up quite nicely in Singapore. And we recently did a detailed revisit of the Singapore business case and updated it with our current performance and the customer pipelines that we've got from our customers. And I can say it's been a very much a strong investment case, even considering the delays we've experienced. And moving on to some of the new and exciting markets that we're coming up to now. So the Malaysian market we've announced a little while ago, and it's a priority market for our customers. And that means that our customers have business cases ready to go to deploy their products and services once a suitable infrastructure offering like Symbio's is available. So the phone number market in Malaysia is very attractive to us. It's highly concentrated with the incumbent Telekom Malaysia, and that provides us ample opportunity to win market share quickly. You can see 83% of phone numbers in Malaysia are still with the incumbent, despite deregulation. So there's a big opportunity there for us to come in and grab some market share. Recently, a big milestone for us is we received a formal notice from the Malaysian government of our Malaysia digital status, which gives Symbio an endorsement as a national strategic initiative by the Malaysian government. And I can't emphasize enough the significance of this to our project, which is the next milestone to achieving a full license for a tier 1 infrastructure service provider in Malaysia. So, you know, we're pretty excited by that, and we're on track for soft launch in Malaysia in February 2023 and full production in May. So keep an eye open for some more news in Malaysia. And very recently, we've announced that we're going into the Taiwan market. So once again, Taiwan is a priority market for our customers. And once again, the phone number market is highly concentrated with the incumbent, where you can see 92% of the traditional phone numbers are with the incumbent there. So we've been doing extensive work on local mergers and acquisitions to support market entry in Taiwan, and we have a very solid deal pipeline, which we hope to be able to announce shortly. So this will allow us an even faster market entry into Taiwan, with product expected to be available by the end of this financial year. So I hear you all thinking, why would Symbio be investing its hard-earned cash and considerable energy in opening up new markets in Asia? So to give you a sense of our business case and our rationale, we put this slide together. It's a little bit busy, but I'll walk you through it. Basically, Symbio has been around for 20 years. We've been operating in Australia and New Zealand, and today we're generating about $202 million a year in revenue, which is about 36 million in EBITDA or 14 million in NPATA. So that's the outcome of the 20-year of investments. And of course, we've had good growth there. You can see 20% compound annual growth in terms of phone numbers. Now, Australia and New Zealand has a limited population. It's our home market, but it has a limited population of both countries combined is 31 million people and a limited phone number addressable market of 88 million numbers. So at the moment, we see ourselves at 7.5% market share here in Australia and New Zealand, and we're targeting 20% market share. So we've still got plenty of growth, and we're certainly seeing those strong tailwinds in our domestic markets. However, it is a limited market. So we're looking at Asia based on our partners' demands and desires. And you can see that Singapore was our first market. Now, Singapore was a learning ground for us and required additional upfront investment to uplift our software platforms to be a flexible multi-market platform. So the total investment in Singapore from inception of the project till break even has been $15 million. And this includes the initial acquisition that we did in Singapore to acquire our license, all the software development we did in uplifting our tech stack, all the property, plant and equipment, and the operating losses until break even. And of course, the phone number market in Singapore is fairly modest at 7.6 million numbers. But regardless of that, as we approach our target market share there, we're seeing a strong ROI for the investment we made, given the market has limited competition and we're getting excellent pricing in that market. But it starts to get more exciting when we extrapolate that business case into the additional markets of Malaysia and Taiwan, which we've just announced. So each of these markets has larger populations and larger total addressable markets for phone numbers. So if we look at those two markets combined, that increases population by 55.9 million people and increases the phone number market by 120 million phone numbers for those two countries. Of course, the big difference here between Singapore, Malaysia, and Taiwan is that we'll be leveraging all the experience and uplifted software platforms that we developed for the Singapore market. So we're anticipating that these bigger, more denser markets will be entered for a much smaller investment. So you can see there that we're only forecasting an $8.7 million investment in Malaysia for 32.7 million people, and Taiwan $10 million for 23.2 million people. So, you know, for a relatively small investment, we're increasing our total addressable market from a population coverage of 31 million to 95 million people, and we're increasing our phone number addressable market from 88 million to 215 million numbers in the space of just 2 years, which is quite exciting TAM growth. Of course, as I mentioned earlier in the presentation, we've diversified our business to include 3 operating divisions: the Telco as a Service, the Unified Comms, and the Communications Platform divisions. Now, this business case is predicated only on the Communications Platform business division. Of course, we do plan to leverage the other divisions in those markets, but the cornerstone business case is based on that first division, which is what we use to go into the market. So it is quite exciting to be opening up those big markets. So to summarize today, you know, Symbio, you know, we've got a unique competitive advantage driven by our proven track record, our tier 1 quality. We have awesome customer experience and very flexible software products. And we're leveraging all of these attributes with our Asia Pacific expansion vision, where ultimately we plan to grow the total addressable market 15-fold with a goal to provision 100 million numbers on our network. And of course, we're well on track with Singapore live and Malaysia and Taiwan underway. So that's pretty exciting. Of course, we couldn't embark on such an ambitious growth strategy if we didn't have the resources to back this up. Our business is in a strong position to invest for growth. We have a profitable cash-generating business with sizable undrawn debt facilities and ample cash on the balance sheet to fund organic and inorganic growth. And we continue to demonstrate our operational track record today by reiterating our EBITDA guidance in the range of 36 to 39 million with strong organic growth across all 3 operating units. And that is my 20-minute summary. Happy to take any questions.
Thanks, Rene. I have a couple of questions in already. The first one, you're putting a lot of investment across now 3 Asian countries. If the ROI in your business plan doesn't eventuate, are you prepared to shut down and exit these markets if it doesn't pan out as expected?
Well, yeah, that's that's a glass half empty point of view there, but I can understand that. So just to be clear, I mean, the Singapore investment that I outlined there is complete, basically. I mean, we've spent most of that 15 million already. There's only a little bit left till the break-even point. And look, we're seeing very strong engagement from our partners. We're seeing their sales pipeline starting to come through. So we do have a very high level of certainty of break-even in Singapore. And similar with Malaysia and Taiwan, obviously they're a bit further away, and we're still to make those investments in those countries. But the feedback we're getting from our partners, which are some, you know, top quality brands, you know, like, you know, Cisco, Microsoft, Google, you know, these are big global brands which are pushing us into these markets. So we have a very high level of confidence of execution certainty there. As I said, we've been in business 20 years, and, you know, we have a great track record of servicing our customers, but also building technology and capabilities to service our products. So we do anticipate success. Now, of course, that's not the question you asked. The question you asked is, well, if it's not successful, what are you planning to do? So the other way to look at that answer is to say, look, we are building a unique asset here. So the capability of operating tier 1 voice communication networks in multiple countries is globally unique. There's a couple of players doing this in Europe, where they've aggregated, you know, about 10 to 15 European markets. Although I will say that Europe is a lot easier with a common market and some of the common regulations there. Asia is much more challenging due to disparate markets, multiple cultures and languages and regulations. But if we can be successful in building the asset, we will have a very unique asset and a very unique business. So you've got then two ways to look at the value. One is, can you execute the ROI? And secondly is, well, how much is that asset worth to one of the big global players? So I've got like a plan A and a plan B there. And I guess plan C is that, well, if it all really doesn't work out, these investments are relatively minor considering the strength of our balance sheet. So I guess ultimately you could say, from a risk point of view, the business is taking measured risk by entering these markets.
And then another question, you mentioned, Singapore's, let's say, break even, moving into profitability after maybe a longer gestation period than planned, and you're now making smaller investments in these two new markets. Should we also expect the time from market entry to hopefully at least break even to be also shorter, building on that experience from Singapore?
Oh, absolutely. So there's several factors that we're anticipating to make the go-to-market experience smoother. The first thing is we've already developed our multi-region platform. We did that investment during the Singapore rollout. So from a technology point of view, we anticipate being able to roll out these markets quicker. So that's going to save time. The second insight we got from Singapore was actually from our partners, where they said to us, yeah, don't wait till you finish building the network before you come and sort of, engage with us and sell to us. We'd rather that you engage with us at the start of the process, and therefore they can actually make their investments and they can be ready to go to market more synchronously when we go to market. So we've actually done that in Malaysia. We've already started engaging with our partners, and we've actually started issuing service contracts now with our partners so that they can review the capabilities and start making their investment cases now in their businesses, so that when we go live, they'll be much closer to going live. So those are two key insights that we took out of Singapore, and we're definitely folding that in to the new markets, which we anticipate. Malaysia, for example, we are anticipating soft launch in February and full production launch in May, and we're planning to launch with 3 to 4 production customers already on the platform at the day of launch. And Taiwan, we're hoping to launch by sort of June timeframe this financial year. So we are pretty excited to be able to execute faster into these markets.
And then a follow-on question. I know you did touch on them. Can you enter South Korea and Japan at the same time as these other 3 markets, or do you want to prove return on investment in these 3, let's say, smaller Asian markets? If we even just think about population first before you're pushing the go button on Japan and South Korea.
Yeah, so the good news is we're already looking at Korea and Japan, but we haven't made any plans to execute. So and that this comes down to then how rapidly and how many resources do we have. So what we're doing is we're pipelining these countries to fast follow, so that we can, take the team that used to work on Singapore, they're now actively working on Malaysia. As they wrap up Malaysia, they'll integrate Taiwan, and then further down into FY24, we'll have that pipeline, South Korea and Japan, so that the resources can smoothly continue integrating new markets, as opposed to trying to bulk up additional resources to integrate multiple markets at once. So it's probably a slightly more modest approach, but it is still very aggressive, because if we can launch 2 markets a year, that's still very rapid growth, and will still allow us to achieve our FY25 goal of having launched all those additional markets.
And then another question, a bit more of a first principles question, Rene. Can you just give us an overview of the revenue, contract cash flow models, and the margins for each of the 3 divisions? So maybe if you just go back to that slide, even this one will do.
Yeah. So absolutely, and so we have detailed webinars on our website from the full year results, where we talk in detail about revenue and margin in each division, and wanted to keep today a little bit more high level. But just briefly, the Unified Communications, or UCaaS segment there on the left, which we sell to large enterprise and governments. We're talking top 2,000 enterprise companies, you can see it's 100% recurring revenue model, which means they will pay a subscription fee per seat in the enterprise. So if the enterprise has 500 employees, they will buy 500 seats from us, licensed seats in a recurring revenue model. And that licensed seat will include all the capabilities they need to enable that employee for unified comms. So that's a phone number, it's inbound and outbound communications, it's all the features that they need, and they just pay a monthly recurring fee. So it's very sticky recurring revenue, and that's the way we like it. The gross margin in enterprise and government is around about 76% gross margin, because largely we're selling our software capabilities into that business. If we look at TAS, Telco as a Service, there in the middle there, once again, you can see it's 91% recurring revenue. The other 9% is usage fees and installation fees and other one-off non-recurring fees, but 91% recurring revenue is very strong recurring revenue. And in the TAS space, we sell a combination of things like National Broadband Network, or NBN, access. We resell Telstra Mobile, 4G and 5G, phone plans, and we sell our voice capabilities, which are, of course, our in-house voice capabilities. As such, the gross margin in TAS is around about 35% gross margin. It is a lot lower, partly because of those third-party products like NBN and the Telstra Mobile, which bring the average margin down for the services in operation in TAS. But still, nonetheless, it's very sticky revenue there. And finally, our CPaaS business there, where we sell phone numbers, you can see we're at 6.6 million phone numbers. It's about 1/3 recurring revenue. And the reason for that is that in the CPaaS area, the phone number is a relatively small component. We also sell the voice minutes, the conversation minutes. So think of CPaaS as selling the Lego blocks, where people like Google and Zoom take our Lego blocks and rearrange those Lego blocks as they need to build their product. So they're buying those components. The recurring revenue stream here is very high margin for us, because it's basically pure software. We're operating at about 86% gross margin, whereas the usage-based revenue in CPaaS is about 30-odd% gross margin there. All of those numbers are in the back of our full year results deck, if anyone wants to go through and recap those numbers.
Thanks, Rene. Question on TAS. It seems very competitive and it doesn't fit with the overall strategy. Have you ever thought of selling this division?
Well, we've just gone through a simplification process where we sold all of our consumer and small business direct business. TAS is still very much within strategy, because it's a partner sales model. So we don't sell directly to the consumer of the product. We sell through a partner, and we have quite a lot of partners around Australia. And these partners are mum and dad system integrators, and they do all the hard work of installation and customer service and support and selling. So it's a very lean business from our point of view, and it relies heavily on our software platforms. And it's also a very attractive pull through for our voice products. So at the moment, we've got no plans to divest of the TAS asset. And as you can see, it's growing at 24% compound annual growth. It's a very solid performer. And we anticipate some exciting growth coming in that space, especially now that the national broadband network rollout is complete. Provisioning of NBN services is much more efficient than it was 2 or 3 years ago. We've got high level of automation for customer self-service, so our partners can really just interact directly with the NBN without them having to build any infrastructure. So it's really a low-touch model. So we're anticipating that to grow. We're also seeing good market share trends where consumers are moving from some of the bigger established tier 1 telco brands into the smaller regional niche brands for things like National Broadband Network and mobile. So we still see lots of growth potential in TAS.
Rene, we'll leave it there. Thank you very much for joining us this morning. We're actually just bang on time. and I want to be respectful of your time and indeed our next presenter. And yeah, we'll keep an eye on the Asian expansion story via the ASX announcements over the next 6 to 12 months.
Thank you very much.
And I will now hand over to Rob Broomfield. Rob, if you want to start sharing your presentation.
I will. I'll just share my screen now and start the presentation. Okay, is that showing up okay, Mark?
I can't see it currently, Rob. Just try it. Yeah, it's coming through now, Rob. Just let's give it a, yeah, I can see the cover slide of your presentation now, Rob. You're good to go, mate.
Great stuff. Okay, thanks, Mark, and good morning, everyone. I'm Rob Broomfield, the Group CEO of AVA Risk Group Limited. It's a pleasure to present to the group to you all this morning. In today's presentation, I'll cover AVA Risk Group in terms of what we do, our recent financial performance, financial scalability, followed by our ongoing growth initiatives. So what do we do? Simply put, we protect critical infrastructure. The group has technologies that apply from the entry access points to, say, a data cabinet in a control room, to all the access points, doors in a building, to all the access points to the building itself. And then you go to the outside of the perimeter, we've got technologies that protect the perimeter of critical infrastructure. And we also go further, we can protect all the long linear infrastructure, that's pipelines, cables, data networks between critical infrastructure. In this presentation, I'm not going to go into a high level of detail about the technologies because I'll end up spending the whole half hour on it, but they're really exciting and it's more important about what we're doing with that. So within the group, we have FFT, which has advanced fibre optic sensing, and all of that's been developed and manufactured in Melbourne, but 90% of FFT revenue comes from outside Australia. We recently acquired GJD, who have optical sensors and illuminators and also work on the perimeter of a site. They're based in the UK and sales are primarily in the UK and Europe, but this actually complements very well the footprint the group had before, which was very much focused upon North America, Asia, parts of the Middle East. Our strength in Europe was not so great, so they help build out our physical presence in the Northern Hemisphere. And then we have BQT that have world-leading smart locking and access reader technologies. They're based in New Zealand, with the majority of their reader sales into the Australian government defence area, and locks are pretty much split between Australia, New Zealand and Europe. So we protect critical infrastructure such as large-scale manufacturing, mining, energy generation and transmission, transport, which includes airports, ports and rail, and of course a lot of government and military. Where are our customers? I mentioned they're global and they're predominantly in the Northern Hemisphere. And on this slide, you can just see some samples of the global industries and applications that AVA has deployed in recent years. Many of the group sensors are for outdoor applications, and we have success in deploying our sensors in challenging sites from Alaska, in the Arctic areas, through the Middle East, through the tropics of Asia and South America. And as I often say, there is nowhere on the globe that the AVA technologies can't be successfully applied. Our solutions are operating in more than 70 countries, and we have thousands of fibre sensing systems deployed and thousands of access technology sites at the moment. So where are we heading? We're using our technology platforms that we've successfully developed and applied to security sensing, and we're now moving into non-security applications. AVA and its technology companies have been actively providing solutions into everything you see on this infographic and more. We can use existing buried fibre infrastructure installed for communications. We can convert it to a very sensitive intelligence sensor, providing advanced situational awareness that is accurate and actionable. And we're building on this to provide predictive capabilities with analytics as well. And all of this is being built on our deep domain expertise from the thousands of real-world global deployments and our ongoing research and development into artificial intelligence and deep learning. So what we're doing is we're actively leveraging the sensing capabilities we've developed over the years for security, and then to develop new world-leading condition monitoring solutions. How do we take the solutions to the global market? And so this looks a bit complex. It's not snakes and ladders, but it does show that the group go-to-market is not a one-size-fits-all. We use the most appropriate. We OEM products to global and regional distributors. We sell our own commercial off-the-shelf products to distributors. We take our more complex solutions through international system integrators. And we've even licensed our technology for countries and markets where the existing go-to-market would not be competitive. And some of you might be aware of a program that we had a couple of years ago, the Indian MOD program, which generated many millions of profit for the company. We've also been expanding our support solutions around multi-year support agreements to give customers annual upgrades of their software, and for a number of reasons that they'll get enhanced cyber assurance with each release, because we test our own software internally to the same standards as the US Department of Defense requires. And we're also providing regular improvements with our deep learning classification capabilities to improve the classification capability to improve detection and reduce any false or nuisance alarms. And in fact, the advances in product and services for these higher end solutions is driving both revenue growth and margin growth, which I'll explain in more detail. I'm often asked about our scalability in terms of, what does growth cost in terms of OpEx? From the work we've undertaken in past years in developing our solutions, what we've got really is a lot of platforms for scalable and profitable growth. And we really focused on what I call high visibility revenue streams, such as OEM and distribution and recurring revenue from the high margin services that we've been putting in place in the last year. And the reason for that is not just to grow, it is to grow, but also to balance the more volatile system integrator or product revenue that the group has had. So we've had spectacular growth years that can often be distorted by large projects, and we're really focused on the underlying growth as we go forward, and also visibility into the future from recurring revenue. And so from the work we've done, we believe we have the platforms to provide growth easily to $70 to $100 million in the coming years and maintaining our gross margin. And as per this slide, it shows that an OpEx expansion in the range of 50 to 70% can support revenue growth of more than 200 to 300%. So it really gives a significant EBITDA leverage in the way that we've developed our solutions, the way we're taking them to market, and our focus on distribution, which is a big growth opportunity, but also recurring revenue from services, which is exceptionally profitable in terms of gross margin. So if we just look at AVA at the operating level, what have we got? We've got strong margins. We've got strong cash generation, and I'll detail that shortly. We have an exceptional customer base, and again, I'll show some examples shortly. But we also have this deep domain expertise and IP, including artificial intelligence and deep learning. And we've got the ability going forward to leverage all the investments that we've done in the past on IP to move into the new markets with appropriate go-to-market strategies. And being globally focused and increasing our global reach, we really don't see any constraints on the market and application size from where we are today. This is a sample of the end users. These are the customers that actually have our technologies protecting their sites. And you can see it's very much global, and they're very sophisticated, most of the users that use our solutions. They're really the blue chip companies. And they also cover all the applications I mentioned before in terms of government, military, transport, oil and gas, and also energy. But maybe just looking at this slide in the top left-hand corner, you'll see a number of US security and military agencies. And if we were looking at a map of the world, the highest density of AVA fiber optic sensing solutions is in the Washington, Virginia area. And we really see this as a strong basis for expansion, particularly in the United States as we go forward. Then if we start looking at our distributors or our partners or system integrators, again, we deal with world-class distributors. We deal with world-class system integrators. And a number of the distributors, the globals, are now signing up to OEM AVA products, which means their brand is on our product and they're selling it through their global sales teams. And we have examples like recent agreements with Dormakaba, one of the world's largest locking distributors, which is a program which we expect to start contributing more in the second half of this financial year. I'll just look at the AVA business in terms of our recent financial results. I mentioned earlier, AVA has delivered very strong cash generation. As a result, we have no debt and a very strong balance sheet. We continue to generate very positive cash flows, and we're able to fund the recent acquisition of UK-based GJD from existing cash and some share capital. The recent cash balance shown here is after AVA Group distributed more than $46 million through special dividends and capital returns over the past 2 financial years. And this was as a result of a successful program in licensing FFT technology to a major program in India, and the proceeds from a successful divestment of the services division in October last year. So the group's strength makes it well placed to pursue and fund growth opportunities on top of strong organic growth and the recent acquisition. And it's with this confidence in growth, we recently announced a regular dividend policy, in which unfranked dividends will be declared based on a total dividend of no less than 35% of EBITDA on an annual basis. Again, just reinforcing, AVA is global, but we've been increasing our focus in investments in the world's largest security market, the USA. And we appointed Jim Viscardi as VP of Sales late last year, and this assisted in the doubling of US revenue in FY22 versus the previous financial year. And as I mentioned, we have approximately 30 exceptionally high security sites in the US, and this is an exceptional base to grow our sales within the US space, and not just in government and military, but in energy and transport, which is picking up very well. The AVA Group has a very stable shareholder base, and I see this as really due to the hard work and investments in our products and platforms, which have given us the strength of real products, real customers, real revenue, and we've rewarded our shareholders with the $46 million in the past 2 years, as I mentioned, through special dividends and capital returns. So I'll look at the macro environment and our growth initiatives going forward. So how are we addressing and leveraging the larger industry trends? Well, across the globe, industry and government investment in securing critical infrastructure is growing, and it will continue to grow, and is highlighted again recently by incidents in Europe that you'll be aware of. Meanwhile, the global expansion of connectivity is creating risks for companies, which they must manage, but it also provides an opportunity for AVA Technologies to help them mitigate these risks. And it also provides a platform for AVA to grow recurring revenue from services that we can deliver through this expanding connectivity. So our solutions are growing to meet the demands for greater situational awareness, including increased predictive capabilities from our ever-increasing sensing and artificial intelligence capabilities. And we've already established the platform solutions and a proven go-to-market strategies to leverage these long-term trends for both existing and new applications and new and existing customers globally. And looking at the recent announcement on our first quarter trading, we're pleased to continue our growth of sales and order intake. So total orders received in the first quarter, as shown here, was $7.8 million, and that's a 55% growth on Q1 in FY22, including JGD. But if we exclude JGD, it's still a very healthy 28% growth. We had our first commercial order for our conveyor monitoring application, which we have a significant opportunity in, and we've invested in some resources in that particular condition monitoring space. We did provide revenue guidance for the first half in the range of $13 to $15 million, but we haven't provided revenue guidance yet for the full year, just due to the uncertainty on timing of product orders, which is still a dominant part of our revenue at the moment. However, we are pretty clear on our expectations that the second half revenue will grow on the first half due to a number of catalysts, which include 6 months contribution from GJD compared to 5 months during the first half, growth in the OEM and distribution channel revenues, and growth in condition monitoring orders based on the successful proof of value trials we've undertaken and the opportunity pipeline and the additional leadership that we recently announced that we're investing in this area, who will be based in Europe and help that whole condition monitoring space. And from the group, the strategic objectives, look, they're pretty clear and we see them as being very achievable. We're going to grow security sales, particularly in the US with our increased sales capacity, and in the UK and Europe with our increased regional capabilities with GJD. We are growing margins and recurring revenue, both from the current and new product install base, by leveraging our artificial intelligence and cyber capabilities. We're expanding our strong security position into the security monitoring applications using our existing platforms. And we have the financial strength to further invest in growth capabilities as needed. So to recap, the group has strong IP. We have large addressable markets. We've got a very healthy, strong margin. We've got strong cash generation and a proven team that's managed COVID-19 challenges better than most. And the management team will be further strengthened from Pietro Corsaro, who's joining this month to lead our condition monitoring business. This complements Jim Viscardi, who joined last year and who's leading our global security sales, and will be further strengthened when Mel McGuinness, who is an exceptional and experienced successful leader of security technology and services companies, starts as the group CEO in January. And on top of that, we've got a well-defined execution plan to grow our share and generate the recurring revenue and deliver profits I've spoken about. So the AVA Group's in a very strong position for growth. Look, I'll stop there and I'll thank you for your interest, and Mark, I'll hand it back to you for questions, but I'll highlight the investor contact details are on this closing slide for any future follow-up.
Thanks, Rob. Just a question on growth opportunities in terms of, further acquisitions. Would they be to, bolster your presence in existing markets or maybe enter into new ones? Or would it more be, niche security technologies that you could, tag on to your array of products and push through just a much bigger distribution network than what the a potential acquired company would be able to do?
Look, a good question. So I think the first thing to say is that we're not focused on acquisitions for the growth that we're planning, but obviously, we'll keep an eye out for something that could accelerate that growth. And the reasons are manifold, but they're all pretty straightforward. We would look at an acquisition, was it very much complementary to the customer set that we have, and would be a good extension of the solution set that we've got? Or would it bolster, as you say, a presence in a geography where we feel that we don't yet have the presence, and it gives us an experienced team? Look, to be fair, I think the global presence that we've been building up, and particularly just added in the last few months, I think is really balanced. We've got, strong presence in North America. We've got strong presence now in Europe. We'll have a CEO that's, based kind of between the two. And so therefore that customer facing team is really in the right place and in a strong position to support the growth, and their capabilities are well proven. The investment in additional resources will be made. It will be relatively modest compared to the revenue growth we expect. So I guess going back to the start, we're not focused on more acquisitions for our growth, but if we see that there is something that will accelerate it based upon their presence, customer relationships, or the technology that's complementary, then of course we'd seriously look at that. And, we've got good strength to consider those things if needed.
And in terms of the competitive landscape, who are AVA basically competing against in the various markets? Or, if we're talking about, integrators and distributors, when they're pitching the product to potential customers, what are these customers looking at as an alternative to what you guys are providing?
So again, another good question. So obviously it's a competitive world, and the question is, where do you fit and what's your differentiation? And what we find at the very high tech end is there's a lot of potential competitors that are touting some technology capability that they feel will differentiate them. We don't try and get lost in the technology. I think it's pretty exciting, but it's more the performance, and it's always should be based around the performance. So what do we have? If we're looking at the fiber space, what most of the competitors that would pop up would be what I call homegrown heroes. They're probably pretty strong, close to home, where they've got strong relationships. FFT is very unique in the whole world. We're actually extremely strong in the Northern Hemisphere, and therefore we actually aren't reliant upon any local homegrown advantage. We're actually competing on a global basis, and I would argue the performance that we're achieving with artificial intelligence is exceptional. Everyone's going to have artificial intelligence, machine learning, but what we've done and what the performance we're proving means that we can actually stand above everybody else in terms of guaranteed performance. Then you look at the BQT, and particularly the locking technology. They've solved problems that others couldn't solve. I mean, Dormakaba and ASSA, they couldn't solve the problem of self-aligning doors. BQT have, and that's why those companies are wanting to put their brand on our locks. And then when you look at GJD, you've got companies like Bosch and others that are huge players in the security space, particularly to do with video cameras, where a lot of their illuminators are used. They're a very big global player, and they're taking that product and putting the Bosch brand on that product. So I think what we're seeing is that when you get the global SIs or the global distributors having such confidence in the product's performance and capability, and obviously, the value, then I think that speaks very, very well. So I think that combination of distributor ownership and OEMing in the distribution space means that they've got really world-class products. Just got to grow it. And on the FFT side, it'll come from a better presence and awareness. And obviously, it will be complemented by growing from security, which will grow, but also this new condition monitoring space that we've got a real lead on in some of the applications. And what we're getting is that domain expertise, feeding it back into our solution set, rapidly increasing it. So there's companies out there, but I really don't feel that we're threatened by any of them. And I think at the end of the day, our performance just stands out.
And just a question on FX, because it's come up a few times over the 2 days, especially with the strength of the US dollar over the last 6 to 9 months, and basically nearly all of this year. How does a very strong dollar really impact AVA? Is it more of a net positive given how much business is coming out of the Northern Hemisphere? Or is it a bit of a headwind if you're billing in dollars, but maybe the local currency is what some of your customers are operating in?
Yeah, and it certainly does obviously have a big impact, definitely. But generally, a high dollar, US dollar, is a good thing. Most of our revenue is sold in US dollars or currencies that are pretty much aligned to it. So it certainly has a positive impact on the revenue. Obviously, it also has an impact on some of our cost of goods, where some critical high value components will be priced in other currencies, and some of them, although not based in the US, will price around US dollar. So I guess that's a hedge in one way. And also, if you think about where we've been adding and have grown our customer facing teams, many of them are paid in US dollars or equivalent. So overall, there's a bit of natural hedging that's going on there in terms of, if you look at the gross margins and so forth. But certainly in Australian dollar terms, revenue certainly goes up. OPEX might go up a little bit, COGS might go up a little bit, but I'd say overall it's a positive, but it's not as binary as it just affecting one of those levers because of the natural hedge we've got with our cost base and our COGS base.
And then just by virtue of the nature of AVA as business, we've seen a gradual easing of supply chain disruptions and, shipping costs coming down. Have you started to feel that in your business, lead times coming down and getting components you need to actually execute on projects on client sites, over the last 6 to 9 months?
So the first thing I'll say is across the whole AVA team, the performance of the company and the production and the logistics teams has been extraordinary. I've spoken to many other technology manufacturers that just can't supply, and some of the bigger competitors in some of those industries just don't have supply still. I think for some of them, there's still a sting in the tail in terms of supply chain issues where critical components can suddenly go end of life quite quickly. So I think that there is a lot of work that's still going to have to be done over the next year at least. Is all I can say is the teams are on top of it and been working very hard to stay on top of it. But certainly I'd say the logistics constraints have certainly eased, and that's kind of important for us because most of what goes out of the factories in New Zealand and Australia is air freighted somewhere else in the world. So that's good. In terms of supply chain and volatility on electronic components, no, that still goes on. And, we've got now planning out to 1 to 2 years to make sure we can secure our supply lines. And we're very responsive to any issues as they arise. So we've managed it well. It's not going away, and it will be here for at least another year, and we'll continue to manage it to the best of our abilities.
Okay, Rob, and let me just check if we've got any more. No, we don't appear to have any more questions, and we are just about up on time. We might be finishing a minute or two early. I'd just like to thank you for coming back in and presenting us today, and I think this is maybe your 3rd time presenting the AVA story to the Coffee Microcaps broader audience. So it was great to get another update, and hopefully when the new CEO starts in January, we can get them in to continue the updates at some stage in the second half of 23.
I'm sure, absolutely. Thanks very much, Mark.
Thanks, Rob, and thanks everyone. That concludes the Coffee Microcaps Technology Conference Day 2. For anybody who missed yesterday, fear not, the recording will be up on the YouTube channel tomorrow morning, as will the earlier presentations from this morning. Today's session will also be up on the YouTube channel tomorrow. Thanks everyone who joined us this morning, and look forward to hopefully some people joining our regular Coffee Microcaps morning meetings over the next couple of weeks as we run into Christmas. And I'll wish everybody a good rest of their Wednesday. Thank you.